Right now, something is happening that most investors are ignoring. A number just came out. It has only been this low 3 times in 46 years. The University of Michigan Consumer Sentiment Index just printed 53.3. That is below the 60-point level that has historically signaled recession territory. The last times we saw numbers like this were the 1980 stagflation, the 2008 global financial crisis, and the bottom of the 2022 bear market. A new YouGov poll shows that 42% of Americans now fear a total economic collapse. The CNN Fear and Greed Index just hit 8 out of 100. That is deep, extreme fear. Warren Buffett retired with $373 billion sitting in cash and treasury bills. Every single fear gauge at once, the VIX, the AAII Bearish Survey, the Conference Board Expectations Index, all of them are flashing red simultaneously. Every single one of these indicators is screaming fear right now. In March 2026, the Conference Board Expectations Index also fell to 70.9. That is below 80, the level that historically warns of recession ahead. Quick note before we go any further. I am not a financial advisor or a government employee. Everything I share here is for educational purposes only. For your specific situation, always work with a qualified professional. Now, here's the question most people are asking right now. Should I sell? Here's the question smart, prepared retirees are asking instead. Which ETFs have survived every crash since 2000, and where should I hold them? I analyzed every major market crash since the year 2000 to answer that question. And here's the part that most people completely miss. Every single time this sentiment index has been this low in 46 years of history, stocks have rallied 17 to 25% over the next 12 months. After the 2008 low, markets gained 26% from the bottom. After the 2022 all-time sentiment low of 50, the S&P 500 gained 17% the following year. Every single time. The moment to prepare is not after the fear passes, it's right now. So I looked at 5 crashes, and what I found will surprise you. Because the ETF category that most retirees rely on for crash protection, it did not actually protect them. 5 crashes, 1 brutal lesson. Let me walk you through every major market crash since the year 2000. Crash number 1, the dot-com bust. March 2000 to October 2002. The S&P 500 fell 49%. It took roughly 5 years to fully recover. Crash number 2, the 2008 global financial crisis. The S&P 500 fell 57%. That's more than half of everything. Gone. Recovery took 4 years from the bottom. Crash number 3, the COVID crash. February to March 2020. The S&P 500 dropped 34% in just 33 days. One of the fastest crashes in stock market history. Crash number 4, the 2022 rate hike bear market. The S&P 500 fell 25% over 9 grinding months. The Federal Reserve raised interest rates at the fastest pace in 40 years. Crash number 5, the 2025 tariff shock. Markets dropped roughly 19% before recovering to new all-time highs by June. 5 crashes, 5 completely different causes, 5 very different recoveries. Here's the myth. Dividend ETFs protect your portfolio during a market crash. Here's the truth. In 2008, VYM, the Vanguard High Dividend Yield ETF, fell 57%, almost identical to the S&P 500. In the COVID crash, SCHD fell 33%, again nearly identical to the broad market. When panic hits and investors sell everything, correlations go to 1. Everything falls together. Dividend ETFs do not protect your portfolio value in a full-blown panic. But here's what dividend ETFs do protect: your income stream. Dividends kept flowing through every single crash. SCHD never cut a dividend during any of these downturns. That income, that paycheck from your portfolio is the real superpower. So if dividend ETFs aren't the universal crash protection most people think, what is? I looked at all 5 crashes and I found 2 categories that outperformed in nearly every one of them. The 2 ETF categories that won every time.
Category 1, Consumer Staples. The ETF is XLP, the Consumer Staples Select Sector SPDR. XLP holds the companies you buy no matter what the economy is doing. Procter & Gamble, Costco, PepsiCo, Walmart, Philip Morris. These are not luxury items. These are toothpaste, toilet paper, and groceries. People don't stop buying them in a recession. In 2008, while the S&P 500 fell 57%, XLP fell only 33%. In the COVID crash, XLP fell 27% versus 34% for the broad market. In 2022, XLP fell only 14%, while the S&P 500 fell 25%. During the 2025 tariff shock, XLP actually gained 4.4%, while broad markets were negative. 5 crashes, 5 times XLP outperformed the S&P 500, not by a little, by a lot. Expense ratio, 0.08%, nearly free to own. Category 2, Gold. The ETF is GLD, the SPDR Gold Shares. During the dot-com bust, gold rose 25%. During the 2022 bear market, gold was essentially flat when stocks fell 25%. During the 2025 tariff shock, gold surged 21%. Gold is positive or flat in 4 of the 5 crashes we looked at. No other non-equity hedge can say that. Now, here's the supporting cast for a crash-resistant retirement portfolio. SCHD, the Schwab U.S. Dividend Equity ETF. Expense ratio 0.06%. Current dividend yield of 3.45%. And here's the critical number. 98.5% of its dividends are qualified, taxed at the lower capital gains rate. In 2022, SCHD fell only 18% versus 25% for the S&P 500. SCHD held up in the slow, grinding bear market and never cut a dividend. XLV, the Healthcare Select Sector SPDR. Healthcare spending doesn't stop in a recession. People still need their medication and their doctor visits. In 2022, XLV fell just 16%. During the 2025 tariff shock, XLV was the top-performing sector in the entire S&P 500, up 7.7%.
Look at the bottom row, TLT, long-term treasury bonds. In 2008, they gained 34%, a beautiful hedge that year. But in 2022, TLT fell 31%, worse than the stock market itself. Bonds work in some crashes and fail catastrophically in others. Consumer staples and gold have been the most consistent across every type of crash. Before I show you the most important part of this video, drop a comment right now. Tell me, does your retirement portfolio currently hold any of these defensive ETFs, or are you mostly still in growth? I read every single comment. Now I have shown you which ETFs survived every crash since 2000, but here is what almost no other channel talks about, and it could cost you far more than any market downturn. It is not just which ETFs you hold, it's where you hold them in your retirement accounts. And the difference for a retiree can be $10,000 to $15,000 a year in taxes and Medicare surcharges. The retirement tax trap inside these ETFs. Let me introduce you to Margaret and Dennis from Colorado, both 68, both retired. They were doing everything right, or so they thought. They held JP, the JP Morgan Equity Premium Income ETF, in their taxable brokerage account. JP pays around 8.5% yield. That sounds incredible, and during the 2022 bear market, JP fell only 14%, one of the best performances of any ETF that year. So what's the problem? Here's the problem. Roughly 85% of JP's distributions are not qualified dividends. They're ordinary income, taxed at your full income tax rate. For Margaret and Dennis in the 22% bracket, most of that yield was taxed as ordinary income. But it gets worse. Every dollar of that income added to their modified adjusted gross income. And Medicare doesn't like when your income gets too high. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a Medicare surcharge based on your income from 2 years ago.
For a married couple filing jointly, if your MAJI crosses $218,000, your Medicare Part B premium jumps from $202.90 to $348.10. That's an extra $1,948 per year per person, nearly $4,000 for the couple. That's the IRMAA cliff, and JP income in a taxable account can push you right over it. Margaret and Dennis also didn't realize their dividend income was triggering the Social Security tax torpedo. Here's how it works. Once your provisional income crosses $44,000 as a married couple, up to 85% of your Social Security benefits become taxable. And in that zone, every extra dollar of dividend income creates $1.85 of taxable income. Your effective tax rate in that zone can hit 40% or higher on income you thought was taxed at 22%. Now add the RMDA trap. RMDA's required minimum distributions are calculated based on your December 31st prior year account balance. Margaret and Dennis had a combined IRA of $1 million at the end of 2025. Their 2026 RMDA is roughly $40,650. Then markets dropped 20%. Their portfolio is now worth $800,000. The IRS still requires the full $40,650 distribution. They're forced to sell shares at depressed prices. Here's the fix. SCHD's 3.45% yield on that same $1 million account generates about $34,500 in dividends annually. That covers 85% of the RMDA without selling a single share. The dividend income becomes a natural cash flow buffer that stops forced selling at the bottom. 3 tax traps, 3 solvable problems, and the solution is simpler than you think. The Smart Retirees Account Placement Playbook. The fix is not which ETFs you own. The fix is where you own them. Let me walk you through each one. JP belongs in your Roth IRA, not your taxable brokerage account. In a Roth, JP's distributions are completely tax-free. No ordinary income tax, no MAJI impact, no IRMAA surcharges, no Social Security torpedo. The high yield stays entirely yours. SCHD and VYM belong in your taxable brokerage account. Why? Because 98.5% of SCHD's dividends are qualified, taxed at 0 to 15% for most retirees. You also have the option to harvest tax losses during market crashes. And when you pass shares to your heirs, they receive a stepped-up basis, potentially eliminating capital gains taxes entirely. GLD belongs in your Roth IRA. Gold ETFs are taxed as collectibles at a maximum federal rate of 28%, not the standard 15% capital gains rate. Holding GLD in a Roth eliminates that punitive rate completely. Tax-free growth on a hedge that has outperformed in 4 of the last 5 crashes. XLP and XLV belong in your taxable account. Mostly qualified dividends, low turnover, minimal unexpected capital gains distributions. Here's what this looked like for Margaret and Dennis. They moved JP from their taxable account into their Roth IRA. They moved SCHD into their taxable brokerage account. The result, an estimated $6,200 per year in saved taxes and Medicare surcharges. Not by changing which ETFs they owned, just by moving them to the right accounts. And here's one more move that a market downturn makes possible: the Roth conversion window. When markets drop, your traditional IRA is worth less on paper. If your IRA drops 20% from $500,000 to $400,000, converting those shares to a Roth means you pay tax on $400,000 instead of $500,000. At the 24% bracket, that's a $24,000 tax saving. When those shares recover to $500,000, every dollar of that gain is tax-free forever. It also reduces your future RMDAs, which reduces your future IRMAA exposure. Right now, with the S&P 500 down roughly 5% year-to-date, that Roth conversion window is open. The prepared retiree's final move. Let me bring this back to where we started. Consumer sentiment at 53.3, a number we've seen only 3 other times in 46 years. After the 1980 stagflation sentiment low, the market rallied 25% the following year. After the 2008 crisis low, it gained 26% from the bottom. After the 2022 all-time low of 50.0, the S&P 500 gained 17% the following year. The pattern is clear and it's consistent. The smart, prepared retiree doesn't sell into this kind of fear. They use it. They hold XLP for consistent downside protection across every crash type. They hold SCHD for growing, tax-efficient dividend income that covers RMDAs without forced selling at the bottom. They hold GLD in a Roth for a hedge that works when stocks and bonds both fail. They use the market downturn as a Roth conversion window. And they have their ETFs in the right accounts, so the tax system works for them, not against them. Fear is everywhere right now. The 42% who think collapse is coming are genuinely scared. Warren Buffett's $373 billion cash pile makes headlines every day. The noise is loud. But the retiree who has the right ETFs in the right accounts sleeps well, because they did the work that most people skip. Every other video tells you which ETFs to buy for a crash. I'm telling you where to hold them, because the wrong account can cost you more than the crash itself. If someone you know is worried about their retirement portfolio right now, share this video with them. It could save them a real headache and a real tax bill. Drop a comment below right now. Which of these ETFs are you already holding in your retirement accounts, and do you have them in the right place? I want to know where you stand. If you're building retirement income and want to stay ahead of changes like this, subscribe to this channel. I cover everything that protects your income in retirement, every single week. Coming up next, the JEP-Q tax trap. A lot of retirees are holding this ETF for its high yield without realizing the tax problem hiding inside it. That video is coming very soon. You don't want to miss it.